Hey everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And as always, I'm joined by John Creekmer, and John's our Senior Wealth Advisor and Founder. And John, we're going to be talking about some interesting price action and movement in the markets that we're tracking right now today. But before we dive into that fun topic, how you doing?
I'll tell you, I'm doing pretty good. We had the start of the baseball season, which is always a red letter day for me. And unless you're a Cardinal fan, then it's kind of like, what in the world? We're continuing on from last season. But it's interesting because you can actually track momentum of players. And if you look under the surface of the minor league system for years, you're able to kind of spot trends of things happening. And then you see how it plays out in the big league. I guess we can call that price action as far as in the minor league system. And things, momentum's not been trending well for our beloved Cardinals.
Oh no, they haven't. I watched the game yesterday. It was a little depressing to say the least. But they were playing the Dodgers. Dodgers are great, so
Yeah, for sure. For sure.
All right, well, let's talk about it. A couple of weeks ago we had True Wealth Live, and you talked about a lot of topics, but one of the ones you hit on was the importance of understanding the risk in your portfolio and looking at both portfolio risk, but also price movement in the market. And so, can you refresh for everyone what price movement is and why that's such an important thing?
Yeah, I'll tell you what, when you think about it, so much as far as risk in a portfolio or risk in a stock, a lot of times people look at headline events. They look at things that are happening broad based in the market. And a lot of people were looking at the economy, they were looking at the interest rates, they were looking at rates not moving down. And so some people have really hated the stock market, quite honestly, over the last 6 months or so. And but in doing that, they actually ended up going to a higher cash position or to a high safety position, and they missed out on opportunities. Or they would invest based upon their political lens. If this candidate is in charge of the presidency, well then stuff's going to be bad. Or if that one wins this, well then markets are going to be bad if it's all in cash. And the reality is that a lot of those things do have impact, sometimes short term, sometimes long term. However, you shouldn't be focused on those headline events, except for if you're going to be day trading or trading in a micro period of fashion. But if you're macro investing for longer periods of time, and you're looking to say, when do I invest into a stock or an ETF or a bond or any commodity, and when do I move out of that position, it really needs to do with what we call price action. And price action is really the simplest definition, Drew, is the movement of an underlying price of a security or any type of a publicly traded instrument. But you want to look under the surface and say, what is actually happening with that price movement? Are we seeing it accelerating? Are we seeing more buyers and sellers? Are we seeing the volume numbers going up? The who is buying and selling? So when you understand the action behind the price movement, that gives you a little bit more insight as far as what you should expect on that price.
Yeah. And so, John, I think it's a great way to describe it and to really get to the nuts and bolts of what we're watching in the market right now. And so over the last 6 months, we have seen the major indexes drive forward. But one of the things we talked about True Wealth Live is 7 companies were largely responsible for over 90% of the total return of the S&P 500 over the last 12 to 18 months. And so we are really closely watching those 7 generals to see what is the price movement. Some of them, their earnings have been fantastic, like say in NVIDIA. There's been some great drivers behind why their stock has been doing so well. But what we are starting to see is a number of those large 7 companies, Amazon, Google, Microsoft, Meta, or Facebook, NVIDIA, and Tesla, the price action is starting to change. And John, usually doesn't the price action change or the momentum change before we necessarily see the stock react one way or the other?
Yeah, exactly right. And so typically we start to see a shifting down. So it's never going to be exact, and it's not going to be a science to where you can say this is for sure is going to happen. These are general movements or general trends that we see. But historically, whenever we see the momentum start to move in a negative fashion for a period of time, now that period of time is usually 6 to 7 to 10 trading days. But whenever you start to see that, that's indication that we're going to see a larger move be afoot. So that could be a negative movement or a positive movement. And we have really grid lines in the middle of our momentum tracker that we've built that really starts to identify as we approach that on the downward motion. That means that sometime in the next 5 to 10 days, we're going to start to see a sell signal come up on that position. If we see the momentum actually increasing, approach our blue middle point, that's an indication that we're starting to see more positive momentum. And typically what happens right shortly thereafter, the price begins to follow in an upward fashion.
Yeah. Yeah. And so, John, let's talk about some of these big names that we know are
Mhm.
driving the market. And so the market has moved up nicely so far this year, but it is starting to top out a little bit. And what that basically means is it's not advancing at a fast pace in an upward fashion. And so whenever we start seeing markets top out, it's always good to drill down below the surface. And so we are really focusing on those large seven companies. But John, let's talk about one that is doing very well, and that's NVIDIA. What are we seeing with the price action of NVIDIA right now?
Yeah, very interesting as far as price action in NVIDIA. We're looking. I'm gonna pull it up on my screen here real fast to take a look at it. But we've really seen a shifting down. So NVIDIA is really a huge driver. I mean, up very strongly as far as in price over the last year and a half. They went from about $140 a share up to $900 a share. Phenomenal run. We've owned this into our aggressive growth portfolios, Drew, since 2016. So a lot of long-term capital gains. So you want to pay attention to that if this is a non-IRA account. But all of a sudden, we saw the price action momentum actually start to turn down. We hit a high peak of that going back to the end of January. And end of January, I guess, is a great example. The price was still around $700 a share. And so we saw the price action level out. And then toward about that first week in March, the momentum started decreasing. So whenever we see that, then we start to see a topping pattern from really about the 17th to 18th of March. Moving forward, we saw the stock price actually start to go level and come back a little bit. And so momentum has started to decrease as far as NVIDIA. That does not mean we're full out sell of the stock, but we do want to consider tax impact and maybe start to feather out a little bit from that position and take a little bit of profit.
Yeah, for sure. And John, I think it's a similar story with other mega cap companies like Amazon and Microsoft. Those have been two drivers of the market in recent times. But they definitely are also seeing a similar trend starting to emerge as NVIDIA. The one real outlier in those Magnificent Seven, though, is Google. And actually, over the last 18 months, I'd say Google was the laggard of that group. It really was struggling for some time. But really, in the last week or two, we've seen the price action change in a positive manner, which
It's been incredible, Drew. We look as far as at that price. It's interesting over the really from the end of January, we actually saw price action decrease all the way through that end of February as far as momentum with the price of Google that ended up following suit and started going down, bottomed out around the first part of March, but it has had strong momentum up and to the right as far as on momentum. And then with that, we actually saw the stock actually accelerate from about 135 to 152, 156 here in recent days. So it's a phenomenal run. Now we still have a buy signal on Google, currently, and so we're still watching. I think it's still a strong entry point. So if you're looking at dollar cost average again, dollar cost averaging whenever you have a day or two on the downside, would be a great idea to do.
Yeah, absolutely. And guys, the reason we're talking about in such great detail these massive companies is because of how big of a role they play in the S&P 500.
Hmm.
Now, the S&P 500 is a market cap weighted index, meaning if your market cap's larger, say Microsoft, which is currently the largest company in the world, then you have a larger weight inside of that index. And so those mega cap companies, John, I'm trying to look it up here real quick, but they're over close to 30% of the total S&P 500 is comprised of just those 5 to 7 stocks. And so when we think about seeing price action change with those individual stocks, what does that really mean for the broader market, the broader indexes across the board?
That's a great point, Drew, because whenever we kind of look at the top 10 inside the S&P 500, so oftentimes people invest in the S&P 500 because they actually have exposure to 504 different companies. And why is it 504 instead of 500? Well, there's splits and there's mergers and things like that. So it's always a shifting number of around 500 companies. And Drew, it is what you call index weighting. So it was market cap weighted. So the larger companies have a higher percentage movement impact inside that index. And so, as an example of the S&P 500, Apple represents about a little over 7% of the entire index. So, of the top 10 names in the S&P 500, 8 of them are the Magnificent Seven. Why 8? Well, because Google had a split, and so it's 2 of those top 8. And so the Magnificent Seven is what's been driving the market upward. At one point in time, back in 2013, early on in the year, those 7 made up over 93% of the return of the S&P 500. So it's an outweighted impact. And so you're looking at, and I'm looking at total amount here, Drew, close to 30% is actually made up in those 7 companies. Numbers 9 and 10 is Berkshire Hathaway, United Healthcare Group. That's about 3%. And so if you say top 8 is about 30%, so all of a sudden then, if price action starts to go negative, or no, if momentum goes negative, price action will follow. And if that's the case in those 7, if 5 of them show negative momentum, then you're going to have to say that will impact your S&P 500. And so you guys say, well, John, I don't own S&P 500. But if you look at your 401k, you probably do. And if you're in a target date fund, you most assuredly do. And so those type of things will impact overall as far as your return. And it's interesting, too, that when you start pulling up dividend paying stocks, which were laggards in all of 2023, they're the ones that are having the absolute best momentum across the board since the first part of February. And so it could be a good time to have some shifting in your overall portfolios.
Yeah, absolutely. I think you hit right where I wanted to go next. So what we've been doing in client portfolios is some of that shifting. So over the last couple of months, we have, as we've seen momentum turn negative, we've taken some gains off of the NASDAQ and the S&P 500. Some of those growth stock names that we mentioned, we've harvested a little bit of gain, and we've been rotating down into the Dow Jones and the dividend paying stocks that really right now have much stronger momentum. Overall, you're never going to get it exactly right, like you said earlier, John. But once you start seeing those telltale indicators of the movement coming down the road, it is prudent to make those decisions. And so we have been proactively doing that. Now, John, let's say we were talking with someone that's not a client of our firm, or maybe their 401k is their largest retirement asset. What should they be doing right now as it relates to those investments?
Yeah, I'll tell you, what you want to do if you have money not managed by Creekmore Wealth. Now, if you do, keep in mind we have your risk assessment report that we have handy. You can always take a look at that. We have your matrix of the portfolios and the sleeves that we use with all the information behind that. And actually, we send out on a very regular basis information on those models and how they're allocated. And whenever you make a change, you get information from your advisor. Now, if you have assets that are held away, so they're not managed by Creekmore Wealth, I would encourage you to make sure that in the body of the email, you'll have a link to have a risk assessment done. It's called Nitrogen, and it's how we assess risk in your portfolios. Number one, click on that, and what'll happen is you're going to get a no-cost, no obligation report that's going to help you understand the level of risk in your account that considers momentum and price action. And then secondarily, we can actually break apart your entire portfolio to let you know where the risk is inside of there and show you how we can manage it. Now, that being said, Drew, we have a phenomenal tool in which we have the ability to help people manage their 401ks. We're in a couple of different ways of doing it. For those that are more do-it-yourselfers, we've got a way as far as buying trade signals for one of our partner firms, and it's done very inexpensively. And we have so many people that actually ask us to help them manage their 401k, even a portion of their 401k, and we have some outlets to do that. So, Drew, I would tell people, no matter what the asset is, definitely reach out. We can get you reports and research, and you can decide how to interact with us moving forward.
Yep, absolutely. So guys, there's a link in this email. Feel free to access that risk tolerance questionnaire and go ahead and take that. And then I would strongly encourage you, like John said, to have our team break apart your retirement portfolio. That's your 401k or your 403b, because what we do find generally is you have more risk than what you actually think you do or should have inside of those assets. So it's well worth the time to go ahead and have that assessment done. So guys, thanks for the time. We appreciate each and every one of you. Look forward to talking with you all soon. Have a good day.